Have you ever wondered what happens if you have life insurance and you pass away? Where does the money go? And how can you make sure it's spent according to your wishes? That's where a life insurance trust comes in. In today's video, we'll cover what is in a life insurance trust, when you need one, and walk you through the steps in creating a life insurance trust. I'm Greg Rosdiba, the founder and CEO of Dundas Life. As a digital life insurance brokerage, we've helped thousands of Canadians navigate the complex world of insurance, all from the comforts of their own home. Curious to learn more? Click the link in the description below. So what exactly is a life insurance trust? In simple terms, it's a legal arrangement where you place your life insurance policy in a trust. This trust becomes the owner of the policy, and it's managed by a trustee who ensures that your loved ones receive the funds as intended. When it comes to setting up a life insurance trust, it's important to consider the type of life insurance you use. Whole life insurance is often recommended because it doesn't have an end date. This means that the policy will remain in force, allowing you to distribute your assets as planned. On the other hand, term life insurance offers protection for only a fixed number of years and may expire before you have the opportunity to distribute your assets. Universal life insurance can also be used, but it is challenging to predict the death benefit amount accurately. For these reasons, we generally recommend using a whole life insurance when establishing a life insurance trust. Now let's talk about the parties involved in any trust. There are three key roles to understand. 1. The grantor. The grantor is the person who funds the trust. In the case of a life insurance trust, if you transfer the ownership of your policy to the trust, you would be the grantor. 2. The trustee. This is the individual responsible for holding and managing the assets owned by the trust. They play a vital role in ensuring that the funds are protected and distributed according to the trust terms. 3. The beneficiaries. The beneficiary is a person or group of people for whom the trust has been set up. There are intended recipients of the trust's assets and benefits. Now, why would someone need a life insurance trust? Its purpose is to ensure a smooth transfer of funds to your beneficiaries while minimizing taxes and probate costs. When you place your life insurance policy in a trust, you guarantee that the full amount reaches your loved ones, and you have the power to specify how the funds should be used, such as for education or healthcare expenses. Let's take a real life example. Imagine you have young children and your top priority is securing their education, no matter what happens to you. By setting up a life insurance trust, you can allocate a portion of the life insurance proceeds specifically for their tuition. This way, you gain peace of mind knowing their future is secure and their educational needs will be met. Life insurance trusts for estate planning come in two main forms: revocable and irrevocable. Each type assumes ownership of assets and facilitates their distribution to beneficiaries according to the trust document after the grantor's passing. Revocable trusts give the grantor the ability to modify or revoke provisions, allowing for control over the assets held within the trust. These trusts are commonly used for the purpose of controlled distribution for special needs children, minors, or financially immature adults. It is important to note that revocable trusts do not reduce your estate tax liability. However, they can be beneficial for parents with special needs children who require ongoing care and support. On the other hand, irrevocable trusts cannot be altered or canceled once established. Placing assets into an irrevocable trust means surrendering control, including access to the cash value of permanent life insurance policies. Nevertheless, irrevocable trusts offer advantages such as reduced estate tax liability and asset protection against creditors. Choosing between revocable and irrevocable trusts depends on your individual goals. Irrevocable trusts suit those looking for estate tax reduction, while revocable trusts provide more control and flexibility. Now, let's consider the pros and cons of a life insurance trust. On the positive side, trusts offer the following benefits. 1. Greater control over the distribution. With a trust, you can establish specific instructions on how and when the insurance proceeds should be dispersed to your beneficiaries. 2. Naming a minor as a beneficiary. By using a trust, you can name a minor child as a beneficiary without requiring a court-appointed guardian or custodian. 3. Protection for special needs children. A trust can provide ongoing financial support for a special needs child without jeopardizing their eligibility for government assistance programs. 4. Shielding assets from creditors and probate fees. Placing your life insurance policy in a trust safeguards the funds from potential creditors and certain estate-related expenses. On the flip side, there are a couple of things to keep in mind when setting up a trust. Complexity and expense, for one. Setting up a trust involves careful planning, legal expertise, and paying for associated costs, making it a much more involved process than a standard insurance policy. 2. Careful trustee selection and terms. You need to thoughtfully choose a trustee who will manage and distribute the funds according to your wishes, as well as establish the specific terms and conditions of the trust. While there are challenges in managing a life insurance trust, the benefits of control, protection, and peace of mind for your loved ones can make it a valuable component of your overall financial planning. Let's now discuss how to set up a life insurance trust, which involves a few key steps. First and foremost, you need to select a trustworthy and competent trustee who will manage the trust on behalf of your beneficiaries. The next step is to work with professionals to establish the legal documentation for the trust, ensuring that it aligns with your goals and wishes. Estate planning plays a significant role at this stage as it helps determine how the trust fits into an overall financial strategy. Generally speaking, creating a life insurance trust involves the following steps. 1. Determine the type of trust you want. Decide between a revocable and an irrevocable trust based on your estate planning goals and financial situation. 2. Create a trust document. This legal document designates the grantor, trustee, beneficiary, and outlines distribution instructions. 3. Determine the amount of coverage you need. Consider personal and financial circumstances, dependents, and debts to determine the appropriate coverage. 4. Select the life insurance plan. Whole life insurance is recommended for permanent coverage and potential cash value growth, but term life insurance is far more cost effective. 5. Purchase a life insurance policy. Compare premium rates from different insurers to find the best coverage for the best value. 6. Transfer ownership to the trust. Consult an estate lawyer to ensure compliance with legal requirements, transferring ownership and management responsibilities to the trust. By following these steps and seeking professional assistance, you can successfully establish a life insurance trust that aligns with your specific needs and objectives. When setting up and managing a life insurance trust, it's important to consider the tax implications and legal requirements. Life insurance trusts can be used for estate planning, helping to minimize tax burdens for your loved ones. While the life insurance payout itself is typically tax-free, it is still included in your taxable estate. To prevent potential tax losses, you can use an irrevocable life insurance trust or gift an existing policy to the trust. These strategies can protect the insurance proceeds and reduce estate taxes. To wrap it up, a life insurance trust is a powerful tool for securing your loved one's financial future. By protecting your life insurance payout from unnecessary taxes and probate costs, you can provide your family with financial stability they deserve. Setting up a life insurance trust can be complex, but don't worry, Dundas Life is here to support you every step along the way. We have a team of experienced professionals who can help you navigate through these complexities, ensuring that your life insurance needs are set up correctly. If you like this video, please give a like and comment and subscribe to our channel for more information. Thank you for watching and have a great day.